Hello students, welcome to my class. This is Professor Vincent Usaga, and this is the presentation of part 2 of chapter 13. Chapter 13, Stockholders Equity. Now, in this session, we are going to talk about, first of all, how to journalize the issuance of stock. When we say issuance of stock, another word for that is selling stock. So when we sell a stock, we issue it, all right? So now, here is the accounting treatment or how we record the issuance of stock. Number one, we debit the cash that we receive or any other asset that we receive for that matter. We credit common stock for the number of shares issued multiplied by the par value, and we credit paid-in capital in excess of par for the excess of issue price over par value. We are going to talk a little bit more about that in a minute. But I just want to bring something to your attention at this point, which is par value. The question is, what is par value of a stock? We said that the par value is the minimum legal sales price of a company's stock or share of stock. In other words, legally, you cannot sell your company's stock for less than the par value. Now, how do we determine the par value? The par value is a random amount. When you set up your corporation with the government and you complete your paperwork, you just specify what the par value of the stock is. $1, 50 cents, it is what it is. And by the time you specify that amount and your paperwork or application is approved, then you cannot set the stock less than the par value. So that is what par value is. So moving along, let's take a look at how we record a stock issued at par. What does that mean? In other words, we are selling the stock at exactly at par value. So in this example, this company sold 1 million shares of stock on January 1st for $1 per share. The par value of the shares is $1 per share. So the par value and the selling price is the same. So how do we record the transaction? Obviously, $1 multiplied by 1 million shares, that is $1 million. So we receive $1 million cash, so we debit the cash for $1 million and we credit a common stock for $1 million. Of course, as you know, common stock is part of the third component of the balance sheet, and that is the stockholders equity section of the balance sheet. Moving along, here we issue stock at premium, meaning we were able to sell or issue the stock above par value. So again, we sold 1 million shares for $20, but the par value is only $1. So we issued the stock $19 per share more than the par value. So how do we record the transaction? Obviously, $20 per share multiplied by 1 million, we have $20 million. So we debit cash for $20 million. Now, I want you to take a note of this. This is very important. Common stock account is credited for $1 million. How do we determine that? The par value, so common stock account is always credited as long as the common stock has a par value. It's credited by the number of shares that we sold or issued, in this case 1 million shares, multiply that by the par value of $1. So we have $1 million. So the difference between 20 and 1 is 19. So we credit another account called paid-in capital in excess of par common stock for $19 million. Another way of determining this $19 million is, remember the par value is what? $1, and we sold each share for 20. So the difference between 20 and 1 is $19. $19 multiplied by the million shares issued will give you $19 million. So we credit a paid-in capital in excess of par for $19 million. Moving along, let's take a look at how we report common stock. Again, it's important for you to know here, we are talking about reporting here. Previously, we have been doing recording. When we record the transaction in the journal, ledger, so on and so forth. But now it's time for us to prepare our financial statement. Though this is a partial balance sheet. It's not a complete balance sheet. It's zeroing in on the stockholders equity section, which is our main focus of chapter 13. So as you can see, take a look at how common stock is being reported with the related paid-in capital in excess of par. Moving along, we have been talking about how to record common stock. Here, we are talking about preferred stock, another type of stock. Every corporation must have at least common stock. Now, if you desire, you can also issue another type of class of stock. We call it a preferred stock. And like we discussed in part 1, preferred stock has some preferences over common stock. So take a look at the journal entry for issuing or selling preferred stock. Pretty much the same methodology as the recording of common stock. In this case, that's what happened. The company issued or sold 1,000 shares of its $50 par. In other words, the par value is $50. 6% preferred stock on January 3rd at $55 per share. So, how much did they sold it for? $55 per share, but the par value is $50. So they sold it $5 more than the par value. So of course, 1,000 shares multiplied by $55, which is what they sold it for, that will give you $55,000. So we debit cash of $55,000, then we credit preferred stock, just like we did for common stock. It is important for you to know this. Preferred stock is credited based on the number of shares that we sold or issued multiplied by the par value. In this case, we issued 1,000 shares and the par value is $50. So we credit preferred stock for $50,000, and the difference of $5,000 is credited to paid-in capital in excess of par preferred stock. Again, reporting of preferred stock. Take a look at how preferred stock is recorded in the stockholders equity section. The only thing I just want to bring to your attention is preferred stock is reported before common stock because they have more preferences to the common stock. And of course, in the event of liquidation, the preferred stockholders will get whatever is left before the common stockholders are considered. So, moving along, let's take a look at the objective number 3. Here we are going to talk about how to account for cash dividends, stock dividends, and stock split. Now, the first one is dividend. The first thing that we need to talk about is, no, let's go back to the previous slide. How to account for or how to record, in other words, cash dividends, stock dividends, and stock splits. So let's talk about dividend. What is a dividend before we talk about other issues relative to dividend? We said that, dividend is a fancy name that we give the money that the stockholders receive from the corporation as a result of the profit that they make. All right? So people invest in company stock for 2 primary reasons. Number one, when the company is profitable or when the company makes a lot of net income, of course, that net income or profit belongs to the owners of the company. You have to give them all of the profit or some of the profit. When you do that and the owners receive it, in the world of business, we just give it a fancy name. We call it a dividend. So dividend is a stockholder or the owner's share of the profit that is distributed. So, having said that, let's take a look at some important issues relative to dividend. Number one, 3 important days, declaration date. That is the day the board of directors officially make the announcement publicly that they are going to be making dividend payment. So we call that date of declaration or declaration date. Now, number 2, we also said there is a record date. That is the date the stockholders holding the shares on that particular day will receive the dividend, not after. Now, the payment date is actually the date that the company actually pays shareholders the dividend. Now, here we say that not legally required. In other words, the company can afford to go by 1 or 2 or 3 years, whether they make profit or not, or whether they realize net income or not, without actually declaring dividends. However, publicly, when they make that announcement that they are going to pay dividend, once that announcement is made, the company is legally obligated from that point on. So moving along, let's take a look at what we do in terms of how we recognize or record the dividend, cash dividend, on the date of a declaration or declaration date. We simply debit retained earnings and credit dividends payable. So the dividends payable is a liability, it's an obligation for the company. Now, by debiting retained earnings, as you know, the normal balance of retained earnings credit. By debiting retained earnings, we are decreasing retained earnings. Now, don't forget what retained earnings is. Retained earnings comes from the earnings or the profit or the net income that the company retained. Okay, remember the closing process. We close out the revenues into income summary, close out the expense into income summary. Eventually, we have to close out the income summary into retained earnings. So retained earnings comes from the profit of the company. So whatever amount that we have in retained earnings are the earnings that the company has retained since the inception of the company. So that is the journal entry we make on declaration date. On the record date, there is no entry. Now, on payment date, of course, there is an entry with debit dividend payable and with credit cash. Now, moving along, let's take a look at how we record dividends. Here's an example. As Board of Directors declares a 25 cents per share cash dividend on a 2 million outstanding shares of common stock. So on that date, that is the declaration date, the company at that point in time is obligated to make that payment, and they make a journal entry. 25 cents multiplied by 2 million outstanding shares will give you 500,000. So we debit retained earnings for 500,000 and credit dividend payable common for 500,000. So on the when the dividend payment is made, then we debit dividends payable for 500,000 and credit cash for $500,000. So moving along, let's talk about preferred dividends here. Okay, so preferred dividends are determined by contract and get paid before dividends on common stock. I think at this point in time, we need to wrap up the second part of the presentation, and we'll take it from here in part 3.